Hey Rob, good to see you.
Yeah, same
I know
here.
I know your hair is not as good looking as Dilly's, but we'll just have to deal with it. So Dilly is out today. So Rob is filling in. Rob and I have known each other for years, and for those of you who are wondering, every once in a while I get these songs from. So if you liked it or didn't like it, Mr. Isbits is the one who gets the credit or the blame. I thought it was a great pick. Does anybody really know what time it is? Chicago. Rob, I couldn't believe it. 1969. So
1916. I was
so
five.
and actually that was their first album. I didn't realize this. I forgot. They were originally known as the Chicago Transit Authority.
That's right.
And I imagine, Rob, why did you suggest the song? So, like, why is it more like? Can anybody tell what the hell's going on here? Was that kind of where it came from in your
Yeah,
mind, Rob?
it was something you said the other day. I participate occasionally, and I listen every day to the recordings when I don't catch it live. It's you've got a great thing going on here, and thanks for letting me be a part of it upstage here. As I listen to you and what you say, really over a period of days or weeks. You said something the other day, and I remembered about uh, it's a different environment for sure, but at this point a lot of people think they know what's going on, but they really don't, especially because they are newbies at this. And there's something to be said for experience.
Yep. Well, maybe heretofore, whereas experience has been a liability because we're seeing things we've never seen before. It might rhyme with things that happened before, but truly has been extraordinary. Excuse me. Um, I think it was Jay Pulaski the other day in his latest Substack, and Jay was in the other week. You probably heard him. It was great. He was something about
Yeah.
a time for old men or something like that. Like you want experience now. So yeah, no, it's self-serving, of course, for both you and I, but I think that's right. I think that's right. Um, so Rob, I'm going to throw a question at you. We're going to get to Peter. We have
Yeah.
with us today, by the way, Peter Berezin, Chief Global Strategist of the Bank Credit Analyst. We'll get to Peter in a minute or two. Um, but Rob, like I don't know, I haven't been speaking in spaces lately. I'm just curious what's sort of top of mind for you, or what's got you triggered. I got to tell you, I got triggered this afternoon. I was going to the eye doctor, and I come up behind this car, and the license again, Rob, things you don't see. The things you don't see at the bottom. The guy had a license plate on his license plate, New York plates. Buy stocks, STKS, and I was like, I was gonna, I was gonna back in the guy. I was like, talk about road rage. I mean, I don't know, number go up may have been the only worst license plate I could imagine, but that's kind of my hot button for today. So, Rob, I don't know, you triggered by anything, or you got a strong conviction, or is it kind of
Yeah.
is it kind of like, as I like to say, a joke all the time, Rob?
I,
Buy high, sell low, wash, rinse, repeat. So, what's on your mind, Rob?
Yeah, this happens to be actually perfect timing. I mean, people may know I do a lot of writing under Sun Garden Investment Publishing at Seeking Alpha and Bar Chart now, and some intellectual property things like that. And a lot of it is focused on trying to figure out how much risk is out there at the individual security level, all the way up to the market, broad market level. And I think of it this way: investing is has always been the same to me for, I don't know, 30 something years in the business. uh, Anything can go up at any time for any reason and by any amount. The difference between security A, index B, or country C is how much risk is involved. And just because, let's say, the market rallies, I don't know, 10% from here, okay, over the next couple of months or a couple of weeks, who knows, it doesn't mean that there wasn't a lot of risk attached. And you only figure that out when you get episodes like mid-February until about the 8th of April this year. So, what is triggering me in this environment where I would have figured the last 2 months would have been a sort of come to papa version of this, where people say, you know what, I'm really learning something. I need to start digging in, learning how to be more of an all-weather investor. I mean, the same thing that you and I were taught a long time ago, and that it's not a
Just
matter,
lost you,
it's
Rob.
just not going to happen.
Yeah.
Oh, hello.
You blanked out for 2 seconds. Sorry,
Oh,
go on.
sorry. Yeah, I said, it has to, you know, so much investing, people make it binary now. This is going to happen or this is absolutely not going to happen. And I mean, my latest intellectual property called the Roar score bar chart. I write on it a lot, and it basically says what's the percent chance of the next 10% move in a particular security, say S&P 500, is it going up or down 10%? And you don't know for sure, but as an example, I mean, in my service today, I lifted it. It's been at 10 for 9 weeks, meaning I estimate a 10% probability that the market would rally 10%. I don't mean in a day on a tweet.
Right.
Okay. And, it lifted up from 10 today for the first time in 9 weeks. So it says to me, it doesn't mean, hey, I just called a bottom. There's too much of that out there. And I know you complain about it
Sure.
just as much as I do.
So Rob, I'm thrilled, and Peter, I just want to warn you. This is the first time we tend to fool around here a little bit, Peter, but I just want to warn everybody. Rob, I'm teasing you. Peter, I'm teasing you. I'm sure this is not going to happen. I just want to warn everybody in the audience. There will be demerits handed out. If anyone starts debating this, whether this was a Zweig breath thrust or a Zweig super breath thrust, Rob, no doubt you've seen my feed. I just went nuts. I was so triggered by that. It's just, I mean, everyone's an expert now. All of a sudden, it's like guaranteed the market has to go up now. And the most hilarious thing was, Tom Thornton was in the space yesterday, and I also read this somewhere else. Tom Thornton was saying, probably from the same source, that one of their clients used to work with Marty Zweig and knew Marty pretty well, and he imagined that Marty, if he was still alive now, seeing everyone citing this one indicator would cause him to discount the efficacy of that indicator. So, Rob, it's like they always say, don't try this at home. All the amateur technicians out there and everything. And the fact of the matter is, most of the time we just don't know. It's like you say, weighing probabilities, like when you go to the track. By the way, for everybody out there, Rob likes to go to the track, just so you know. Okay.
Yeah, I'm the
So, so, so
I'm a chicken blank gambler.
Right. So Rob, is you're just trying to compare the odds of on a given horse versus the likelihood that the horse is going to win. It's like like sometimes
Great analogy.
yeah, exactly. So that's what the market's all about. So anyway, all right, let's stop. Enough of this. We came here to hear Peter. So Peter, welcome. You can unmute yourself. Good to see you, Peter. Unmute yourself, Peter. You got to hit the mute unmute button. Rob, where is it on the screen here? Because he's still muted. I'm gonna try to
Let's
unmute
see. It should
him.
be on the left, lower left.
Yeah, try the lower left, Peter.
Oh yeah. Okay. I got
There
it.
you go. Hey,
These-
hey, Peter. Good to see you.
These
figured
young
it-
kids.
Yeah, all of us, all of us. So, Peter, great to see you. I'm going to tease you here a little bit. I gotta tell you something. You got to do something about your picture on the BCA research website, because I want to look up your bio to give you a proper introduction. And oh my God, I can swear I'm looking at Ed Yardeni's kid brother. I'm like, I'm like, wait a second. Like if I didn't know any better, you just take his photo and photoshopped it and stuck it out here. I'm teasing you, of course. But anyway,
I see what you're talking about. I see it now.
you
Yeah.
see it, Rob?
Yes.
I mean, Peter, just because we like the horse around here a little bit, we may actually open a poll on Twitter later on X to vote on whether you should change your picture or not, because this is bad. This is really bad. Anyway, so for those of you who don't know him, Peter is the chief global strategist and director of research at BCA. All right. I have been following BCA since I'm not running a big institution now. I'm presently not taking the service, but I took BCA for, oh my God, 25 years. And Peter, as I mentioned to you the other day, I go way back to the Tony Bach days. And BCA is always a very thoughtful, disciplined view of the world. They call them like they see them. Peter's neither bull nor bear. And I think what everyone's going to find interesting today, less whether or not he's bullish or bearish, because everyone always likes to make a sound about, oh, he's deified 1 minute because the market's crashing, and here's the guy. Let him take his victory lap at a 4450 S&P target at the beginning of the year, and now he's in the Hall of Fame. He's on CNBC and Bloomberg and all these places, right? Now he's a knucklehead because the market's up off the lows, as they would say. Okay, we know the world doesn't work that way. All right. So what I'm really more interested in, I think Rob is as well, and most of the people in the room, Peter, it's not at any one point in time why you're bullish or bearish or market up or down. Because let's be honest, trying to predict market price levels is kind of like a fool's errand. It's a market of stocks, as they always say. But what I find more interesting, I think, be very instructive for the audience, is to understand how you think about markets. How do you get to the idea that markets should go higher or should go lower? So, it's not just the what, and Rob and I talk about this a lot, Peter, it's the why. So, and I didn't realize this, Peter. You used to work at Goldman Sachs, so there you go. So, in any event, Peter, I'm going to shut up. I've got some of your materials, and I'll throw a few charts up as you speak. But take it away, Peter. What's top of mind for you? How you see in the world, and really keen to hear your thoughts because again, you're a differentiated voice, and you've had more than your share of good calls over the last few years. So, Peter, take it away. Floor is yours.
Yeah, I mean, I tend to think probabilistically, which means that I don't like to have a particular baseline view that I cling to no matter what. I'll change my view as the incoming data evolves. I always like to say I want to be a good Bayesian. I want to have a certain set of expectations, but be willing to change those expectations if the data justifies it. And the good thing about this industry is that you don't have to be right all the time. Like we're not surgeons. If you're a surgeon and you kill your patient 45% of the time, you can't say, well, the other 55% they survive. What's the problem? But in this industry, if you're wrong 45% of the time, right 55% of the time, you can make a lot of money. In fact, if you're wrong most of the time, as long as you make a lot more money when you're right than when you're wrong, you can also make a lot of money. So you got to be humble in this industry. You're going to make a lot of calls. Some of them are going to be right. Some of them are going to be wrong. The question is always, what is the evidence pointing to in terms of the most likely outcome? And I think in the current situation, the evidence points to a recession. That was my call going into this year. Part of that call was predicated on the view that we'd have a major trade war. We predicted that in our outlook. But much of the call also just sort of hinged on the idea that the US economy was not nearly as strong as most people were making it out to be. And we'll get the GDP numbers later this week. The last I checked, Bloomberg consensus was around half a percentage point growth. Goldman just knocked down their number to minus 0.8. The Atlanta Fed, even if you strip out those anomalous gold purchases, sees negative growth in Q1. So GDP is the ultimate hard data. People say, well, the hard data is still fine. Well, if we get negative GDP growth in Q1 or something close to negative, that's not all fine. I think the reality is that even before the trade war began, we had problems. We had rising delinquency rates, credit cards, auto loans, commercial real estate. We had a growing inventory of unsold homes. In fact, the inventory of newly built unsold homes is now the highest that it's been since late 2009. And that largely reflects the fact that interest rates are high, mortgage rates in particular are high. 2 years ago, when I was actually quite optimistic about the economy, only 4% of mortgage holders had a mortgage rate above 6%. That number is up to 20%. So it's increased significantly. And I think also the insulation around the labor market is a lot more thin than it was back in 2022. Back then I would always highlight the fact that the job openings rate was over 7%. And that's phenomenally high. Basically, back then, anyone who lost a job could walk across the street and find new work. That's not the case now. We just got the JOLTS data for March. The job openings rate fell to 4.3%. That's actually below the 4.5% level that Fed Governor Christopher Waller has identified as marking the kink in the so-called beverage curve. And the beverage curve just plots job openings and the unemployment rate, meaning that if openings were to fall further, as they almost certainly have, based on the real-time data from places like LinkUp, which tallies up all the job openings on a real-time basis by the 10,000 largest U.S. employers. We're now at that point where if you lose a job, you're not going to be able to walk across the street and find new work. And so the economy is vulnerable. And typically recessions occur when economies are vulnerable and are hit by a shock. And that's exactly the situation that we have right now. So I would be defensively positioned. I would be underweight stocks. I will be overweight bonds and cash. If I had to be in the stock market, I would be favoring defensive sectors such as consumer staples, healthcare, over the more cyclical sectors. This is one of those times where you want to be more cautious than normal.
Got it. So that's a great overview. So let's drill down a little further. So I was triggered by many things you were saying, Peter. I'm teasing you. Um, I'd like to get into your view of the economy before the tariffs hit. So I agree with all the points that you made, the emerging stresses in various indicators. On the other hand, I'm going to play devil's advocate with you, okay? If you look at sort of what was it, the interest obligations of the private servicing debt obligations. Um, if you looked at the fact that so many homeowners have locked in. This is a double-edged sword. There, I haven't looked at this in a couple of months, but I remember a couple of months ago, I think the average rate on the stock of mortgages outstanding was something like 3.9%, which is double-edged sword. I'll come back on that in a minute. But the point I wanted to make more generally was, I mean, a lot of people are running with the narrative of fiscal dominance. That it's fiscal dominance which has been driving the economy, and therefore that's been the real driver. And as long as that continues, we're all good. So it's like they say, Peter, never ask a question you don't think you know the answer to. So I'm gonna ask. It's rhetorical. It's really literal. So given that we've had this fiscal dominance, and I saw a blurb today that I think on a year to fiscal date basis, spending is still running up 220 billion year over year, despite all the talk of austerity. And overall, yeah, there are emerging signs of stresses here and there, but it's a K-shaped economy. Those at the top are still doing all right. What really led you in the direction, though, of a recession called pre, absent the tariff thing, which has really changed the game? Would you still have been calling for a recession absent the tariffs?
Well, we raised our probability of a recession following the election. I think I was probably one of the only strategists to do so because I thought that the particular policy mix that Donald Trump would pursue would turn out to be unfavorable towards stocks. And of course, tariffs are part of that somewhat toxic policy mix. But also, I was really, really worried that fiscal policy rather than lifting equities in the way that it did in 2018 could actually hurt stocks because this isn't 2018. The budget deficit going into this year was over 6% of GDP, which is phenomenally large for an economy that's operating close to full employment. And so the risk that I thought we'd see this year come to fruition was one where uh, the Trump administration tried to push through more unfunded tax cuts. And the bond market simply said, no, we're not going to continue buying bonds at the current yields if the budget deficit is just going to get larger and larger over time. Because what's different now compared to, say, 2018 is that one, there's a lot more debt in the system relative to the economy. And two, interest rates are substantially higher. And so if you look at interest expense as a share of GDP, it's doubled since 2018. It's around 3% of GDP. And if the expiring tax cuts are extended, so we don't even need no taxes on tips, Social Security, overtime. As long as the expiring tax cuts are extended and bond yields evolve with market expectations, interest expense as a share of GDP is going to go up to 6% within the next 10 years.
Hold on, Peter. Breaking. I just want you to say that again. We're going to go from 3% to 6%. That's you're saying. Don't assume rates going up. Just assume the debt continue to increase. Over what period of time do you think we're going to 6% of GDP for interest expense, Peter?
Over the next 10 years. And that assumes only two things. One, it assumes that the expiring tax cuts are extended,
Hmm.
nothing else. And two, that bond yields evolve with market expectations. from the forwards curve, and that's
Right.
it. You still get this very, very spooky increase in interest expense. And so, why is this important? It's important because usually when growth weakens, fiscal policy comes to the rescue. We're not going to have that potentially this time around because the starting point of the deficit is already so large, nor are we likely to have, at least immediately, major cuts in interest rates because the Fed is concerned about inflation. Like if you look at the CPI swap market, which is sort of a market measure of where inflation is likely to go over the next year or two, the CPI swap market is pricing in inflation of around 3.3, 3.4% in 12 months' time. The Fed can't easily cut rates if inflation is so high above target. And also, of course, Jay Powell never say this in public. I don't think the Fed wants to kind of bail out what they see as bad economic policy, particularly the tariffs. Certainly, bad economic policy as administered by Donald Trump. And so we're not going to get monetary relief, at least not immediately. We're not going to get fiscal relief because the bond vigilantes may step in. And that means that any shock to the system could propagate because the mitigating forces from easier monetary policy and easier fiscal policy won't be around to save the day.
Right. So, Peter, put it. I totally concur with that. And put it another way, when people talk about so-called potential Liz Truss moment, they're referencing what happened in the UK a few years back when the UK came out with their annual budget and the market voted with its feet. It sold gilt, it sold the pound. Um, is there somewhat of a analogy to that here, like the Mr. Market? Like if I mean, I kind of wonder, like actually, if we there's a cross currents here, but I kind of look at the level, and the tariffs mess everything up. But I kind of wonder, like if this whole thing gets sorted out, and who knows if and when it will, like isn't there potential that bond yields could go up meaningfully from here, Peter?
I think that's the risk. Like if you think about what happened during the global financial crisis, the crisis itself ended basically in, say, March of 2009. And yet the recession uh, ended up being very, very deep, so deep, in fact, that unemployment didn't kind of go back to where it was in early 2007 for another decade or so. Now, why did that happen, even if the financial crisis ended? It happened because at the peak, you had something like 6% of GDP in residential investment, new home building. And then that number went from 6% to 2%. And so you had this big hole in the economy that wasn't easily filled, and you needed very low interest rates for a long time to fill that hole. Right now, we've got kind of something comparable with fiscal policy. To stabilize the debt to GDP ratio, you need a budget deficit of around 3.5% of GDP, right? We have a 6.5% of GDP budget deficit. If the bond market forces fiscal consolidation, we're going to lose 3% of GDP in demand, and the private sector won't be able easily to step in and fill that void, which means that we could have a recession that is not V-shaped. It could be more U-shaped or even L-shaped, and that would be quite bad for stocks because it would imply a prolonged period of lower corporate profits.
You just touched on a very, very important point, and I think even more. I mean, look, nobody knows the future, as you say. We're dealing with probabilities. But what do you think we're getting? Just sluggish growth, or we're getting a technical definition of a recession, or we're getting the real McCoy? What I'm really triggered by is the last thing you say, Peter, and that is coming out on the other side of this. I don't see where the impetus for better corporate profits and economic growth comes from. I mean, we're tapped out on fiscal. And given the inflation outlook going forward, I think the amount of monetary largesse we're likely to see is severely diminished. So I just think, best case, we're kind of like going sideways rapidly. I don't know. Your
And,
thoughts?
and even if you have the profits, what will people pay for them versus what they've
Yeah,
been paying for them?
yeah.
Yeah, yeah. So I think that there's two important considerations here. One are the current level of corporate profits sustainable. If you look at profit margins, they're at record highs. And indeed, if you look at kind of price earnings ratios, let's talk about whether they're high or not in a second. But first, let's discuss whether those earnings estimates that are used to calculate price earnings ratio are realistic or not. Right now, as we speak, bottom up analysts expect earnings to grow by around 10% over the next 12 months. So they haven't really priced in any meaningful damage from the trade war or the economy. And that 10% earnings growth is supposed to occur on top of what it already is, as I said, record high profit margin. So those earnings estimates are way too optimistic. But even if you take them at face value, even if you say, okay, those earnings actually will be realized, you still have the fact that the price earnings ratio now is back above 20. Okay, that's high. Between 2015 and 2019, which of course was a span of time which didn't include a recession, which encompassed most of Donald Trump's first term. So we already had the tax cuts back then. The average forward P ratio was 16.8. Okay, so we've got a 20 PE right now, and we had 16.8 at a time when the economy was actually doing reasonably well. So what does that mean? It means that the market is assuming a lot of good news. If that good news doesn't materialize, we're going way down. If it does materialize, okay, stocks can go higher. We can probably go back above 6,000 on the S&P. But the point is that the risk reward outlook is skewed to the downside.
There you go. That's exactly what my whole reward opportunity and risk ROA score tries to do. Gauge. It's a tug of war, right? It's like the old tug of war game you played in camp, and it's not over until one side's pulled the other side over entirely. And I did want to ask you, Peter, and it's Rob. Great to be with you. When will the market care? Because isn't it so much of this a confidence game? I mean, it's one thing to have it, sort of plain in front of us, but when does it care for more than a couple weeks at a time, like we saw earlier in April?
Yeah, markets tend to experience what I like to call Wile E. Coyote moments, where they kind of run off a cliff, but don't realize that they're about to fall until they look down and see the ravine under them. You see that all the time. We saw that in 2008 after Lehman collapsed. We saw that uh, in 2020. Remember, everyone was very kind of optimistic about COVID initially. Oh, it's just going to be like SARS, no worry. And then all of a sudden, we started to see cases pop up in Italy, and it's like, oh my God, this is really, really serious, and stocks just crashed. Same story again with the tariffs. So, what will be the Wile E. Coyote moment this time around? It'll be clear evidence that we're heading into a recession. So, I don't think we've got it yet, but we could get it this week because we've got a bunch of data coming in, ADP, payrolls. Maybe the data will be strong, maybe not. If it ends up being weak, then I think people are going to say to themselves, you know what? There's been a lot of damage to the economy already. Economies are very nonlinear. Once unemployment starts rising, usually it keeps rising. If people begin to price in meaningfully the risk of a recession, we're going to go straight back down.
So it's to continue the Warner Brothers analogy. Would you say it's been rabbit season for a long time, but at some point it's going to be duck season?
That's right. That's right. Beep, 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 right?
Beep 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 beep. Okay, we're gonna call you Beep Beep Berezin from now on. I just made that one up. There you go. So Peter, I want to go and I'll throw this up. I'll throw this chart up in what's called the nest, so some folks will be able to see this. But in one of your recent reports, I was really struck by you were showing how U.S. earnings growth has, you know, outpaced handily that of other markets. I think that dynamic is fairly understood, well understood by most, the Magnificent Seven. But what I really found interesting about your chart was you showed the earnings growth for the equal weighted market. And I think it'd be even probably the similar, but it'd be even more cool if you did the S&P 493. Anyway, the point being that, the earnings, equal weighted earnings growth for the market overall is been much less than the S&P in general. It's still done better than other foreign markets, but there's also a valuation question that if I said to you, hey Peter, you know what? Let's look at equal weighted, and we're not even gonna we'll get into the dollar in a second. But to me, even when you go through the mental gymnastics of saying, okay, let's look at the equal weighted or let's look at the 493, the US still looks expensive relative to everything else. Do I read this correctly, Peter?
Yeah, I mean, even the equal weight is quite expensive relative to its own history. And of course, valuations depend on one's expectation of earnings growth. But
Sure.
the fact of the matter is that outside of those magnificent seven stocks, earnings growth has been fairly paltry. If you look at, say, the Russell 2000, there's been no earnings growth for the last 4 years. People talk about
Mm. And
American
there won't be.
but really, when they're saying American exceptionalism, they're talking about a bunch of large cap tech companies that have seen phenomenal earnings growth. You can actually look even at the NASDAQ equal weight. People don't really look at that series, but it is available. The earnings growth for the NASDAQ equal weight has been well below that for the market cap weighted NASDAQ. So what's going on here? What's going on here is that you've had a few tech companies with really superb earnings growth and everyone else with mediocre earnings growth. And that tech growth, that growth in tech profits has really reflected monopolistic uh, gains that have stemmed from the fact that there are all these kind of network effects involved in technology. So people use Office because everybody else uses Office. People use Instagram and WhatsApp because that's what everybody else uses. It's not at all clear. I think this is kind of a key point. It's not at all clear whether that dynamic will apply to AI, for example. The thing about AI is that my use of, say, ChatGPT doesn't necessarily improve the experience of somebody else who uses ChatGPT. There's no network effect there. I don't care what other AI people use if I use a particular one. It's also true that unlike, say, software, where there's a big fixed cost and fairly small marginal cost, so you have these economies of scale, with AI, there's very high expense in running these models, both in terms of maintaining the data centers and also just the power consumption and the chips that you need to power these models. So in many respects, AI looks a lot like, say, airlines or even shale, where you have a commoditized product, very similar in many cases across models, and very high front end capex costs and very high depreciation rates. So airlines are very important for global commerce, but they never make any money because there's so much competition. There's so much spending that needs to take place to maintain a fleet. I fear that's going to be the same issue with AI, in which case those big profits that everyone is banking on might not materialize.
Peter, I love you, man. I think so many people are going to be triggered by what you're saying. Hey, Rob, listen to this guy.
Yeah.
Peter, I agree with you. Peter, I've never heard someone put it the way you do. It's like shale or airlines. Like, oh my God.
Hey,
So,
hey,
so, so,
George.
Rob, so, so, Rob,
Yeah.
Rob, Rob, Rob. So it's like airlines are shale, but paying 20 times revenue is okay. Did I get that right, Rob?
Yeah, right. It's funny. I mean, just before Pete was talking, and I swear we didn't rehearse this, but I was just running some stuff here. A lot of the stuff I've been writing about is, I don't think that a lot of investors realize just how mucky a market this has been since the beginning of 2022. Peter, I'm sure you know, but you start talking about the equal weight, and I ran these quickly. So you're talking now, we are, what, 2 months short of, what, 3.5 years? So 22, 23, 24, and a third of the way into 25. The S&P 500, more than 40% of the stocks are down the last 3.25, 3 and a third years. And
40%, 40%,
40
Rob?
over 40%. The
Right.
median return is 3%, and only 30% of them are up more than 10%. annualized
So,
over that, including dividends,
so Rob, just to be clear, those are annualized returns, 3%.
Annual, yeah, that's right. Annualized. Yep. Yep.
Wow. And by the way, for everyone, and Peter, I know it's your first time in spaces, so I hope this isn't being it's not as bad as going to the dentist. But for everyone out, there's this thing called the nest, Peter. If you touch above your head, you can see it says one post shared in this space. If you touch that, you will see. I tweeted out. I took a screenshot of your graph showing the earnings growth of the various indices, and so everyone in the room can see what you're referring to. I think that's a really arresting chart, Peter. I thank you for presenting that.
Well,
So
George, there, the maybe the follow up for Peter, you talked about the PE ratio still being pretty elevated, but I'm wondering, does this finally make this closer to a market of stocks as opposed to a stock market? In other words, indexation has kind of muted so much of active stock selection, and I wonder if maybe even if it's a quarter to a third of the S&P that's just gotten bludgeoned the last 3 years and 4 months, does that make it so that maybe not at the high level you're super bullish, but you're maybe more bullish on the idea that stock selection might outperform finally?
I mean, in general, the returns on stocks kind of follow a power law. So you're always going to have a few stocks with exceptional returns and a lot of stocks with very, very poor returns. But that seems to have been accentuated beyond kind of the normal range over the last few years, where you just had a few mega cap stocks doing extremely well and most stocks doing rather poorly. And it
Yeah.
does, I think, speak to this whole question of whether the underlying drivers of the stock market have really revolved around US economic exceptionalism, or whether they sort of revolved around mega cap monopoly profits in the tech sector. I tend to be in the latter camp.
Or money pouring in index funds, pushing
right,
everything up regardless.
right.
Yeah.
So let me just move the ball forward, Peter. I want to go to another part of your report. So we talked about where we're supposed to be. Ultimately, it's great we can debate the economy, we will, but it gets down to where we're going to invest. So let's stay with this U.S. exceptionalism thing for a second. All right. So I even take a different definition. When I think of U.S. exceptionalism, I think of the extreme fiscal profligacy. Like we run bigger deficits and spent beyond our means more than anybody else, and that's driven growth more than any other place. And that's kind of coming to the end because Mr. Market's is in the process of putting an end to it. But so Peter, there's been a lot of talk lately of, and let's not even put words on. Let's not get into the word U.S. exceptionalism because that triggers some people. But the idea that all the capital flow to the U.S. Um, we had a guest a couple weeks ago was citing some flow numbers, I think out of Asia and Europe together. I think it was like 25 trillion. The numbers aren't not important, it's just order of magnitude. And the point he was making was that a very small percentage of that money had started to flow out. That given the perceived unsoundness of U.S. economic policies, the increasing geopolitical problems, et cetera, and then also if any deal is struck, like once you've broken trust, like how easy is it to repair it? That money at a minimum starts coming here and maybe starts to turn back. And so, what's your sense? Have flows started to reverse? And more importantly, I think I read you correctly. Expect the dollar to go weaker. So, what does it mean for you in terms of the dollar and currency relationships?
Yeah, I mean, I think the problem that a lot of foreign investors are having is they say to themselves, okay, well, the US may not be the b- top choice anymore, but where do I go instead? Like Europe has its own problems. We talk about fiscal issues in the U.S., but France, Italy, Spain, Belgium, the UK—they all have debt to GDP ratios above 100%, and they have slower trend growth, partly due to slower labor force growth. So they're not going to be able to grow out of their problems easily. I mean, Germany can do fiscal stimulus, but that's just Germany. In fact, what we're seeing now across Europe looks a little bit like what we saw in the early 1990s, where Germany was ramping up to do stimulus to pay for reunification that was driving yields higher across the whole region, making life very difficult for anyone in the exchange rate mechanism. And of course, that's where George Soros and Scott Bessent made a lot of their money betting on the collapse of that system of fixed exchange rates. So Europe isn't necessarily a safer alternative. Japan has its own demographic issues, debt issues. China, we all know the issues around China. It's not just, trade policy. It's the fact that the capital account really isn't flexible. So you can put your money in, but can you really take your money out? A lot of uncertainty around that. And that's kind of helping to keep the money in the US. And it's also kind of forcing people to look for kind of safe havens beyond the normal major economies. That's why gold has done so well. People don't want to buy US dollars, but they don't want to buy euros. They don't want to buy the Chinese yuan. So they buy gold, and the price of gold goes up.
So
Bitcoin has also benefited from that.
yeah, do you? I mean, I personally remain very bullish on gold. What do you take of it? What's your take on gold or Bitcoin at this point?
I think gold is the safer alternative. It is expensive in real terms. It's sort of back to where it was in the early 1980s. But that might not be the right metric for gauging whether gold is too expensive or not. I would say that any uh, precious commodity, such as gold, its price should increase more or less in line with global income. Now, since 1980, global income has increased tremendously. And by that measure, gold still looks fairly cheap. So I think there is scope for gold prices to rise further. Bitcoin, I'm a little bit more skeptical about, unlike in the case of AI, where there were applications uh, emerging almost instantaneously. With Bitcoin, we still haven't really seen a lot of applications other than holding it as a store of wealth. And maybe that is the application, who knows? But people don't use it as for transactions. They don't use it for most types of commerce. So I would prefer just to go with the tried and true, and that's gold.
Got it. So a couple more questions, then we'll open up to the audience. Uh, Peter, it looks increasingly obvious that we're in a recession, about to go in a recession, and quite frankly, some of the anecdotal evidence we're getting is truly horrific. The speed of the decline. So rather than debating whether we're going to have a recession, I'd like to ask you a slightly different question, and that is, do you think it's how possible, not is it possible, how possible or likely is it that we could have some resolution, in a reasonably short period of time? You can draw the line wherever you want, say 1 month, 2 months, whatever. We have some type of resolution, sufficient resolution, maybe not total resolution, but sufficient resolution that maybe the market, and I'm sure Rob would love this question too. The market says, "Oh, okay, yeah, we had a recession, but that was kind of like a one-off, and don't worry, we put Humpty Dumpty back together again, so it's like a non-recurring one-off." I'm obviously asking you a question, Peter. I don't believe, but I'm just trying to, posture with you. And we put Humpty Dumpty back together again, and it's like a non-recurring one-off. It's like it never happened, and we can just go back to the way things were before. Ridiculous question, but have at it, Peter.
Um, I think it's quite unlikely for there to be a major uh, cooling in the trade war over the next month or so. Like, I'm sure the Trump administration wants to kind of walk back some of those tariffs, uh, but they're not going to be able to do that unless other countries such as China offer some something in return. And I think in the case of China, they're kind of sitting back and just enjoying the show at this point. They're watching the U.S. economy stumble and probably head into a recession. They're watching all these long-standing alliances that the U.S. has created with many other countries break up. From their perspective, they don't want to stop this show. They can afford to basically tell Donald Trump that they're not going to offer anything for the next 3 months, 6 months, 12 months. I mean, China's not as exposed to the US as it once was. Chinese exports to the US as a share of Chinese GDP is 2.8%. Okay, it was
Wait, wait,
7%.
wait, 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 wait. Say that again. 2.8%.
Yeah, Chinese exports to the US is 2.8% of Chinese GDP.
Wow.
So it's
Wow.
not that big, right? Now,
No, 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 Peter, famous. I tell you, I got to go and have to listen to the replay of this. You got some real zingers here, Rob. We got, and Peter, I'm agreeing with you. I'm not disagreeing with you, but the way you put it, like 2.8%, I don't know what's more outrageous, only 2.8% of GDP, or this AI stuff is like shale or airlines. But go on, keep it. So 2.8%, and also, Peter, aren't they increasingly trying to improve their trade situation with Silk Road, other Asian countries, Africa, all these other places.
Wait,
So I mean,
to be clear, Peter, you 2.8% out of China's what's the GDP running? In other words, not 2.8% of the total GDP. I just want to make sure for
yeah, it's
everybody.
2.8% of the total Chinese
yeah,
GDP.
with China's GDP was probably about what 18 trillion, Peter, something like that. I've lost track. I don't remember the
Well, it
exact
depends on
number.
whether you do it in
So
foreign currency.
is it
2.8%.
2.8% of the
Yeah,
total or
2.8% of GDP, Rob. 2.8% of GDP, not of exports.
hmm,
GDP.
Yeah.
okay.
So you're right, Peter. It's not that big a deal, and also they've got the leverage in terms of a lot of the stuff they produce that we can't do without. So anyway, we interrupted you, Peter. So you were
Yeah,
saying that they're not as exposed as people think they
yeah.
are. Go ahead.
I mean, the true number is probably more than 2.8 because some of Chinese exports rerouted through like Vietnam and places like that.
Sure.
But the point is that they're not nearly as desperate to make a deal as the Trump administration would have you believe. They can sort of sit back and watch. The thing is, we talk about how there's a global trade war. There isn't a global trade war. There's a U.S. trade war. The U.S. is at war trade wise with the rest of the world. The rest of the world is not at war with itself.
Yep.
And that's a key difference. It's sort of like, why did Napoleon lose when France was the biggest country militarily in Europe? They lost because they went to war against everyone. Britain, Russia. And so when you try to go to war against everyone, it doesn't matter if you're the biggest dog in town, you could still end up losing. And that's sort of what the Chinese perceive. So I don't expect a deal there. Could we get deals with other countries? Probably not in a way that would satisfy the Trump administration. The thing is, outside of China and a few emerging markets, trade barriers on U.S. goods are not that high. The U.S. has basically free trade with many countries,
But they've
Canada.
been ripping us off, haven't they?
Well, that's the message that
He
you
said tongue in
hear.
cheek.
Right. But I think you have to ask, like, what is really driving this U.S. trade deficit? I like to call kind of Trump's perspective on trade critical trade theory. The idea that if the U.S. runs a trade deficit with another country, it must be because that country is discriminating.
There's another one, George.
This guy.
Another one
So,
for the replay.
so I don't know if Rusty's here, but whoever's taking critical trade theory. Oh my, Peter, you should do stand up. Seriously, seriously, FinTwit comedy. You're on fire, dude. You're awesome. We love this critical trade theory.
He's not even loaded like Van,
No,
right?
no. Peter, we got to talk offline. I think you have another career sidelight. We have to talk to you. I think your services could be used in our spaces. All right, so Peter, just hang right there for a second. So I want to bring in Peter, and Peter, good to see you. Peter, I'm sure most of you guys know him. He's always bopping around. He looks at things international. He's got a pretty formed global perspective. So Peter, please unmute yourself. You have a question for Peter? Peter?
Yeah, hi George.
Hey.
Hi Peter, fellow Peter to Peter. I have to say that is a good joke, and I might be stealing it if that's all right. It's quite funny. But I did have two quick questions for you. One is a maybe rose tinted European, but do you not think that if the Europeans can get their act together in terms of their financial restructuring and generally issuing enough debt correctly, making some savvy fiscal decisions, that the euro might become more of an attractive alternative to the dollar as a reserve currency in the longer term? I'm not talking about immediately, but I think, this is 100 days of Trump And already we've seen more geopolitical and diplomatic shifts than we've seen, I think, in an entire administration. So there's a lot of people here who are quite bullish about Europe. I know it's slow growth, but as a bastion of stability, at least. What's your thoughts on that? And then I've got a follow-up question.
I think there's no doubt that the euro will, over time, be more of a competitor to the dollar. But I think the key line here is over time. This is not a short moving progression. If anything kind of comes out of this trade war, which could be quite positive, is that it will force reforms in those countries that have been slow to enact them. And that includes Europe. It also includes Canada. I mean, we're based in Canada here, and we have interprovincial trade barriers. It's often difficult for one province to trade with another province. Hopefully, what's happening now will catalyze efforts to increase economic unification in regions that should be unified to begin with. That includes Europe. But again, this isn't going to happen over the next 3 to 6 months. And unfortunately, when I'm talking about a recession, I'm talking about a recession that does start within the next 3 to 6 months. And it will ultimately engulf not just the US, it will engulf Canada, it'll engulf Europe, it'll engulf Japan as well.
Right. Hey, by the way, Piotr, why don't you? I got a question for you, but go ask your second question, Piotr, and then I got a question for you, Piotr. Go ahead, Piotr.
Like saying my name by the sound of it.
Look, Pietro, this is terrible. Though. It's like at least you have the good decency to spell Pyotr. We had a space like a few months ago. Everyone was Michael. It was just insanity. So, just Pietro, don't change your name to Peter. Then we're gonna have a real problem. Go
No,
ahead.
I'm not. I'm
Go
gonna,
ahead. Go ahead.
I'm not gonna be afraid to say I am half Russian. My name is Pyotr,
Okay.
Tchaikovsky, all that.
There you
So,
go. There you go. Go
we're
ahead.
owning it at this point. But yeah, my follow up is sort of related to what you said, Peter, and I think it's a good point, and I'd love to have you on my show as well if you're interested at another time. But it's basically, a good distinction, I think, between a US specific recession and a global, I don't know, recession or depression or whatever words we want to use. So you do think that this is going to translate over into Europe and Canada, despite Mark Carney being, I think, a very savvy guy. I'm quite keen on him, to be honest with you. Um, and China. I mean, China is okay, but they do have their own structural issues. They've issued what $1.4 trillion of fiscal budget or whatever, additional funding for the economy in light of the tariffs. Do you not think that China could still face a bit of a economic sort of headwinds or not?
Oh, no, no doubt China, it will face major headwinds that will only intensify over time, not least of which because its real estate market is in real trouble. If you look at housing starts, they're down like 70% from their peak. And given that there's 20 million excess housing units, 20 million vacant homes, population is shrinking, that demand for housing isn't going to come back. My point is not that China is without its problems. China has huge problems. My point is that politically, they will just grin and bear it. It's, I think, very, very important for the Chinese Communist Party to maintain an image that it's completely in charge. And giving in to Trump, especially kind of given the way that the Trump administration has treated China publicly, is just something that they cannot do. And so they'll suffer if they need to. But unlike Trump, who has to worry about the midterms next year, that's not something that President Xi worries about. They do have kind of the luxury of time. And so my point here is not that China will not suffer from a trade war. They will. My point is that they can bear that suffering.
Wow.
China tends to operate in decades, don't they, Peter? Whereas
No,
we're
no,
looking at
no, no,
tomorrow.
no, no, Rob. Centuries, centuries.
Yeah.
I hate, but normally I don't allow the conversations to go off the rails much here, but I'm going to make a digression just because Piotr, this is kind of question you would have the answer to, and I think Peter and everybody else in the room would probably be curious to the answer. If you have any special insights, Piotr, please let us know. Otherwise, we'll just move on. Piotr, do you have any sense of have you gotten to the bottom of what happened in Spain or like what's behind why the whole power system went down. I read, nobody likes a good conspiracy theory greater than yours, more than yours truly, but I haven't spent enough time on it to figure it out. So Pietro, have you gotten to the bottom of it to satisfy your curiosity, Pietro?
Well, I mean, look, I think that is the single largest outage in modern history, at least from what I understand. Like, it hit two-thirds of Spain's electrical grid and a good half of Portugal's. Where it hit more was obviously urban and condensed areas like cities. Rural areas relatively, what's the word, escaped. But there was something that I read which was kind of weird, which was that they said, quote unquote, rare atmospheric phenomenon. And then someone else also said the words anomalous oscillations in
Yeah.
very high voltage
Yep.
lines,
Yep.
which
Yep.
is kind of cryptic, and I think deliberately, as the sort of the government trying to say they think that this might have been sabotage
Yep.
or some kind of
Yep.
nefarious intent. My problem is that obviously most people go, "Oh, it was Kremlin. Oh, it was Putin," but some, that does go on to the border of conspiracy
Yeah.
because as
Yeah.
much as
Yeah.
I think Putin interferes in foreign issues or
Sure.
European affairs, Spain and Portugal have been some of the least vocal about the war in Ukraine.
Yeah.
Spain contributes of any of the larger economies in the euro the least to the NATO budget. Portugal is very close with Britain, but doesn't really have much interest in that regard. I can't see why Russia would target these two
Yeah.
countries
No.
out of the
I
blue.
yeah.
I
I
think it's a
agree with you.
phenomenon. I think
Yeah.
it's a atmospheric phenomenon, to
Yeah,
be honest with
I
you.
agree. But anyway, all right. So let's just table this. Peter, stay up on stage. I'm sure there might be some more questions. Let's move on. And you know, this guy's got a really cool name. That's why I brought him up. Also, he has a pretty good profile. But anyone who has a Twitter handle of Elon Gates gets to come on up. So, Elon Gates, please unmute yourself. What's on your mind? You got a question for Peter? Elon Gates?
Yes, hi. Yeah, so I guess just my question is, with the upcoming unemployment rise, which I mean we all know is going to happen. We got the AI tech bubble burst that could possibly happen. Commercial real estate crash, which people have been calling that for the last few years. Residential housing problems right now that could possibly crash. Crypto crash. We got the trade wars going on. We got obviously the Bank of Japan. They might hike rates this year. They may not, but we had the yen carry trade unwind. We have a bunch of geopolitical issues. The Schiller PE ratio, which up until a few months back was, I believe, the second or third highest. I think since the Great Depression was at about 38, and obviously, which is under the radar right now, but bird flu. Okay, obviously, because we know that's being kept under the rug right now. So I guess my question for Peter is that has there ever been a time in history when we had this many bearish catalysts, which can possibly all happen at the same time within the next 12 months?
I'm glad I'm not the most bearish person on the spaces today. I mean, I think if you kind of stand back and look at where we are more broadly, it's not that bad. I mean, this isn't the start of World War II. The U.S. is still a phenomenally wealthy country. AI, whether it generates a lot of profits or not remains to be seen, but it's certainly generating really interesting and useful applications, which are going to raise productivity growth over time. So my view is not that of a perma bear. I was actually quite bullish on stocks in late 2022 and into 2023, and I'm prepared to be bullish again as long as valuations reset to a level that incorporates some of these risks that you mentioned. We're not there yet. We're not there at 5,600 on the S&P. We might be there if we go down to around 4,500. At that point, I'll be happy to turn bullish.
Okay, and sorry about that. Just one more question.
Go for it.
In the next 12 to 18 months, do we see a regional bank collapse?
It's likely we'll see some regional banks collapse. because if you look at the trend in delinquency rates in commercial real estate, they're still rising and they're spreading beyond offices. Now we're seeing rising delinquencies for apartments, for hotels, and regional banks hold about 70% of commercial real estate loans. And unlike, say, the larger banks such as Chase, for example, those smaller regional banks are not as well capitalized. And yes, we could see some bank failures. Now, will they be of the sort that we saw in 2008? That sort of leads to a financial crisis? Probably not, but we could see something more akin to, say, what was experienced during the second half of the 1980s and into the early 90s with the savings and loan crisis, which brought down many regional banks, also due to commercial real estate exposure. That didn't lead to a crisis per se, but it did lead to an extended period of slower credit growth, and that weighed on the economy and contributed to the recession in the early 1990s.
Appreciate that. That's great questions. All right. Next up, we have Lincoln Express. Lincoln Express, please unmute yourself. You have a question for Peter? Lincoln Express. Earth to Lincoln Express. All right. Rob, you have a question?
Sounds like the Lincoln Tunnel Express is in. There's nothing there. It's stalled.
Yeah. No, I hear you. I hear you. All right, let's go to. We got to be careful, by the way, Rob, with who we let up on stage because we've had our share of. We had this disastrous space. I don't know recall if you were there a few months ago. So.
Well, when you told me it was on X and it was a space, I assumed that.
Yeah, no, it's it was
Always
rough.
risk.
All right, so let's go to modal. Where'd he go? He disappeared. I think he disappeared.
Okay.
All right. Okay. So Peter, you're overall, just so people understand, if anyone's got another question for Peter, please raise your hand. Come on up. So Peter, just to be clear, to go back again, because it's great macro discussions, but again, what do we do about it? How do we make money? You're pretty defensive about things. Do you think a recession we're already in recession, and we'll be in one very shortly if we're not already there? And if you have to be in equities, you'd be in the more defensive parts of the market. You're also not a believer in a big dollar, but you do like gold. If I got it right, is there anything else that is sort of high conviction for you? Like bonds. It sounds like you're, I don't know, pair of twos. I listen to you talk, and I'm not left with a strong view on bonds one way or the other. Did I misunderstand you?
Yeah, I think right now I would be reluctant to load up on the long-term bonds. Once we have kind of clear evidence that uh, we're going into a recession and the Fed will have no choice but to cut rates dramatically, at that point you can buy Zeros and TLT and all these kind of long duration bond ETFs. Right now, it wouldn't be kind of top of my list to the
Got it.
extent that you want to hold more cash now. It doesn't have to be US dollars. I've liked the yen. The yen probably is going to strengthen against the US dollar over the remainder of the year. It's a very cheap currency, trading at a massive discount relative to its sort of purchasing power parity, fair
Right.
value. That's sort of the exchange rate that equalizes the price of a basket of goods and services across countries, like the Big Mac index, but for all prices. Yen very, very cheap on that score. It's a super defensive currency. It even strengthened against the Swiss franc during the early days of COVID and during the Lehman meltdown. So that's a currency that you want to own. I would also add that you can sort of trade around these market movements, use volatility to your advantage. So, for example, going into Liberation Day, we had been advising clients to own puts on the SPY ETF. Then we had this
Here.
big sell-off, and we
All
just we
year.
closed that.
All year.
So the question is, you want to be tactical in some cases, right? We had this big sell-off in stocks. We closed that recommendation for a gain of 500%, and then just waited, and then just
Got it.
days ago decided to put on another short position. Let's see how that works out. So
Got
you
it.
don't have to just buy and hold. You can sort of trade around the volatility and use that to your advantage.
Makes
Peter,
sense. All right, Rob, let's try to get some other
go
folks
ahead.
on. So Modal, you're back. Can you hear us now, Modal? Please unmute yourself.
Yes, I can hear. Yep.
Good, Modal. Well, you got a question for Peter? What's on your mind?
I do. Liquefied natural gas. So I know that the Biden administration kind of put a pause on, you know, exports and such. But with the Trump administration, I've seen the charts only just bust. I know that China's kind of backing out of purchases, even though they only make up like a small portion of our exports, maybe like 6%. So what's your outlook on liquefied natural gas?
I mean, I don't tend to go that granular, but let me kind of give you kind of a broader view around energy prices, and I'll try to sort of weave in my view on LNG in the process. So it's clear that a lot of countries, if they wanted some quick concessions to the Trump administration, buying more LNG would be an easy way of doing it because they need a lot of that energy anyway. And so Europe could pick up the pace of LNG purchases. But would that necessarily benefit LNG producers in the US? To some extent, it would, but not as much as one would think, because LNG, like all energy, trades in a global market. So if Europe is buying more LNG from the US, it's probably buying less LNG from Qatar. And ultimately, what's going to drive the price of LNG, what's going to drive the price of oil in general, is global demand for oil. And in a recessionary scenario, global demand for oil is going to go down. It's not going to go up. We expect the price of Brent to trade down to $50 a barrel. So this is not, in my view, a period where you want to be owning energy stocks. Certainly not with recession risk as high as it is.
Terrific. Thanks for that, Peter. Great question. All right, Ari, you're up. Ari, please unmute yourself. Do you have a question for Peter, Ari? Your mic's not on, Ari. You got to unmute yourself.
Low batting average here today.
I actually have another question. If
Yeah, could you? Yeah, if you go ahead, Eli. Yep, go ahead.
Okay, so in December 2022, we had the reverse repo. Obviously, I would think it was over 2 trillion. For the past few months, it's been hovering around 50 to 150 billion. I guess my question, Peter, is what happens when that hits zero?
Um, I'm not too concerned about kind of these issues around the Fed's balance sheet. I mean, for one thing, there's still quite a lot of excess bank reserves, and two, the Fed has all sorts of ways to adjust how many bank reserves there are in the system to prevent liquidity issues from boiling up to the surface. In general, I'm not too worried about liquidity. I'm much more worried about solvency. The Fed can't do much about solvency, whether it's the solvency problems faced by regional banks and their exposure to commercial real estate, or the solvency problems faced by the federal government and its unsustainable fiscal situation. That the Fed can't do much about. When it comes to managing liquidity in the banking system, they've got plenty of tools to do so.
So, Peter, let me ask you, following on that question. Great analogy. I'm sure you've got a good line for this as well. So you look at the U.S. and normally in this situation, I'm going to be melodramatic here a little bit, so I'm going to exaggerate. Not that I ever do that, but normally, if you had a country where you had a balance of payments problem, and so far we've been able to just, they give us their stuff, we give them pieces of paper, financial assets, and that trade's been working. But normally, if you have a country which has a huge trade deficit and the currency is weakening and the bond market's in question, an organization like the IMF or somebody would come in and say, okay, you have to pursue some austerity, tighten your belt, cut spending, and raise interest rates. If anything, we're doing exactly the opposite. I mean, we have a Fed chair who, Trump either wants to fire or wants to fire, whatever. There is no austerity. Doge, I keep tweeting out as performative theater. We're doing exactly the opposite, and so it just kind of makes me just I don't know if there's part of me is just saying that's just wrong, and Mr. Mark's going to punish that behavior. And certainly relative to real assets like gold, the value of the dollar goes down. I also think it's going to go down against other fiat currency, but it just this is just the opposite of the policy you normally would expect, for a country in similar circumstances. Now, I acknowledge we have the world's reserve currency, so this gives us, some flexibility that others don't. Like, when Sweden gets into their problems, or Argentina, or whatever, you borrow in somebody else's currency, you got a problem. But it just strikes me we really have been abusing this reserve currency status, and ultimately, this is gonna go to a bad place. Thoughts, comments, reactions?
Yeah, I remember during the financial crisis, people used to talk a lot about the Minsky moment, this sort of idea that stability begets instability. That if you have a period where everything's very, very calm, then people are going to borrow, banks are going to be eager to lend. That eventually leads to a lot of debt. And at some point, the debt gets so large that you have a crisis. We've got something similar on the fiscal side because people have regarded the US dollar as a reserve currency because they've always figured that there's kind of this fundamental backstop behind their treasury purchases. Then they can keep on buying US bonds regardless of how large the budget deficit got, regardless of how large debt levels grew. We've now reached that point where that stability, which allowed for rapid debt growth, is starting to be questioned. That's one reason why treasury yields have not fallen more, even though the economy has clearly slowed. People are starting to worry about these longer term solvency issues. And unfortunately, the Fed can't just step in and bail out the US government. I think there's kind of this perception, okay, if yields go up a lot, then the Fed will just buy bonds and that'll drive yields lower. I mean, yes, that is true if yields go up to like 7% or something like that. But keep in mind that buying bonds at a time when investors are worried about fiscal solvency is basically the equivalent of debt monetization. And the Fed has a legal mandate to maintain price stability. Debt monetization would not be consistent with that mandate. And so, yes, they'll intervene if the economy is melting down, but they're not going to intervene and buy treasuries with a 10-year yield of 4.5%, for that matter, even 5%. Probably we need to see yields go way above 6%. And if that happens, then a recession is becoming inevitable.
So Peter, just stay with that for a second. If I'm not mistaken, you look at the return available, say, to a Japanese investor investing in the U.S. 10-year Treasury on a hedged basis. It's wholly unattractive.
Yes. Mm-hmm.
And so you look at how all the capital, I just pick on them, but you could look at the euro, whatever. Um, the line about never depend on the kindness of strangers. Um, I just kind of wonder. I go back to, it's not that these other places are so great, but it's where people invested. Like, all the capital came here, and you see like some UK funds, European funds are like that. It's ridiculous. Some of these stories I read, they're 70, 80% invested in the US, so on and so forth. The money just goes home. It's like, it just seems to be gonna have a real problem. And so I don't know. I hear you on gold. We're in total agreement on gold, but I also wonder. You mentioned the yen too, and by the way, again, we're trying to help people make money in this room. It's a simple. I think it's a great idea. Again, not financial advice for everyone in this room. Check it out yourself. But I believe the ETF of it is FXY. So
Love my FXY
yeah.
call
So
options.
so so if it winds up not working, just understand. Everybody take that. I'm gonna dox Rob. So don't blame Peter. Don't blame me. This is on Rob. Okay. F
I
F
said I
F
love them. I don't know
F
if anybody else does.
FXY. Rob Isbits. Okay, here we
Yeah,
are.
yeah.
So between, I don't know, Peter, between gold and, on the one, own some gold, own some yen. I mean, I think you can do a lot worse than that. No, I mean, this is one of those times when it's just hard to find a lot of things that are all that attractive, in my humble opinion. But I don't want to put words in your mouth. Is that your view?
Yeah, or just hold cash. I mean, you don't even have to go into the more exotic stuff. Have a nice buffer in your account. If we do get a recession and stocks reset to a more attractive valuation level, probably a PE ratio of like 16 rather than 20. If that happens, then use that excess cash to buy all the stocks that you've been dying to own, and now you'll be able to get them at a lower price. So there's no harm in just waiting. You don't want to be completely in cash, of course not, but you do want to have kind of bigger cash buffer than would normally be the case.
Well,
Yeah,
Peter, what George just did, providing personalized recommendation. No, just kidding. Is you're saying cash, but really, if you think about it, okay, any investment, whether it's an ETF or direct in foreign currency, kind of six of one, half a dozen of the other. Uh, any thoughts of maybe diversifying the cash by currency at a time like this because of some of the pressure on
yeah,
the
yeah.
dollar?
Yen, dude, yen.
Oh, I know. So I'm saying Peter said cash, but just be
Peter,
clear.
no, Peter's got a bank account in Tokyo. He owns yen cash, right, Peter?
It's actually very easy. I don't know if you have like
Oh
interactive.
no, it's very
You have
yeah.
an interactive brokers account. It's very easy just to buy yen. So, I mean,
Pe-
it doesn't have to be yen. The Swiss franc is a very defensive currency. There certainly are currencies out there that are quite defensive and will probably strengthen against the dollar in times of stress.
George, I think we missed the elephant in the room here. So before we're done today,
Yeah.
mind if I
What?
kind of split this?
Yeah. Go ahead.
So okay, Peter, are you based in Canada still, or you're originally from Canada?
We're based in Canada,
Okay, Toronto or elsewhere?
Montreal.
Oh, Montreal. Okay, great.
Mhm.
Um, so three words that I have not heard uttered in weeks: uh, Canada, Mexico, and fentanyl. And I'm wondering, as a Canadian citizen and full timer, less so Mexico, and really not about the fentanyl. I just kind of threw that in, but it is kind of funny how all of a sudden it's not part of the conversation. But can you maybe give us a on the ground, I mean, perspective from, let's call it, a Canadian consumer and Canadian investor? I mean, I live in South Florida, and I keep hearing stories about how next winter the snowbirds from Montreal and elsewhere are not going to be here in droves like they usually are. So, does that have the potential to cause more than a momentary disruption right here in this continent?
Yeah, it's an interesting point. Like the U.S. runs a trade deficit in goods. That's something Donald Trump always likes to remind everyone of. But what he doesn't often say, maybe he doesn't know, I'm not sure, which is that the US runs a trade surplus in services. Okay. And some of that service revenue stems from tourist receipts. And by all indications, fewer foreigners are keen on traveling to the US. That's partly because there is kind of this discussed that the Trump administration is sabotaging their economies with tariffs. But it's also realistically, we've heard all these sort of stories about people being detained, even like prominent scientists being detained, crossing the border, and who wants to deal with that? So this is going to hurt the economy above and beyond the effect of kind of higher tariffs and what that has on consumer and business spending. And being based in Canada, you really see that. I mean, historically, Canadians have had fairly high regard for Americans. We've always seen our relationship as being one of close allies. And the fact that people were booing US sports teams,
Hmm.
hockey games, basketball games, baseball games, that's kind of unprecedented. And I don't want to be melodramatic. I've got a friend who grew up in Ukraine, and he recalls, like, the Ukrainian fans booing the Russians 20 years ago or so, and and of course, where did that lead to? And I'm not saying there's going to be a war, or that the U.S. will invade Canada. Almost certainly they won't. But it does kind of speak to the fact that the current situation is very, very unfortunate. And so, yeah, fewer people will be traveling to the US, and that's going to hurt the US economy.
Terrific. So, Rob, I think Peter's gone beyond the call of duty. We're an hour and 20 minutes into this. So, seeing no other questions, Peter, I really want to thank you. I hope you really learned a lot from you. I hope you enjoyed it as much as we did. And, I told you it wouldn't be too bad. So, and you probably get a lot of requests for people wanting to, you should trademark some of those lines before this. Pietor's already, he told you he's going to steal it. So whatever. I mean, so no, Peter, I hope you come back again. This was awesome. And
it was outstanding, and I mean that in all seriously.
Yeah, it was. So Peter, thank you so much again, and I hope we'll see you again before too long. Take care, Peter. Thank you.
I really enjoyed
Thanks
it.
a lot,
Thank you very
guys.
much.
Thanks, George.
Good night, everyone. Bye bye.